With chapter number 17 from your economics book of grade 12, and the name of the chapter is Government Budget. So what is the meaning of government budget? The budget of the government is an annual fiscal statement describing in details the estimate receipts and proposed expenditures and disbursements or distributions as which is made by the government under various heads of the financial or fiscal year 1st April to 31st March. It is a description of the fiscal policies, taxation and public expenditure policies of the government and the financial plan corresponding to these policies. While the budget gives estimate of the upcoming or the coming financial year, it also gives the actual financial accounts of the previous year and the revised estimates of the current year. So, let us understand what are the types of government budget we are having. Union budget. The budget in India is divided on the basis of different layers of the government, like the central government, the state government, the local bodies. Each layer of the government prepares, passes and implements their own budget. So the union budget is the budget prepared by the central government of the country as the whole. Also, till 2016, the budget was presented in two parts, namely railways budget and the general budget. So, railways budget show the details of the estimated receipts and proposed expenditure and disbursements by the railway minister on regard to Indian Railways only. The general budget showed the financial plan of the entire economic describing in detail the estimated receipts and proposed expenditures of the economy as a whole. The totals of the receipts of expenditure of the railways were incorporated in the budget statement of the Government of India. However, since the budget of 2018 and 19, the budget have merged the railway budget and with the general budget. So what is the state budget? In India, we have the federal system of government, and with the union or the central government of the whole country, the state government, and from different parts of the country. Therefore, every state government in India prepares its own budget. State budget is the budget prepared by the state government, and such as the budget of the Delhi government budget or the government of West Bengal, etc. Similarly, the local bodies such as the municipal corporation, municipal committees and municipal bodies also prepare their own budget. These are the two kinds of budget you are having. Next, what are the components or the structure of the government budget? One is the revenue budget, other is a capital budget. So revenue budget shows revenue receipts of the government and the expenditure made for this revenue receipts. Thus, revenue budget consists of revenue receipts and revenue expenditure. Revenue receipts is the of the government are all those receipts which are non-redeemable. Now they create a non-reliable or involve a no sell or reduction in the assets of the government. Revenue receipts comprises of tax revenue like income tax, excise duties, and non-tax revenue like interest receipts and profit from the other public sectors and so on. Next is the revenue expenditure related to the expenditure incurred by the government on day-to-day normal functioning for the government and interest payment on the government debts. The expenditures neither create any physical or financial assets nor reduce any liability on the government. The items of revenue expenditure are expenditure incurred on law and order, defense, interest payments, subsidies, etc. Capital budget. Capital budget comprises of capital receipts and capital expenditure of the government. It shows the capital expenditure of the government and financing of these expenditures. It is an account of changes in the assets and liabilities of the government. Capital receipts are the receipts of the government which create liabilities or reduce assets of the government. The main components of such receipts are borrowing of all kinds and all kinds of loans and repayment of loans and advances of the central government by state governments and public sector enterprises, and so on. So capital expenditure are those expenditures of the government which lead to creation of physical and financial assets or reduction of the financial liabilities. Such expenditures are incurred on creation of physical and financial assets like land, building, machine, equipments, and so on. Next, we are having balanced budget versus deficit or surplus. So under this, we are having deficit budget. When the government expenditure exceeds government receipts earnings, the budget is said to be the deficit budget. Next, we are having what is revenue deficit. Okay, what are the types of budget deficit we are having? So first is revenue deficit. The concept of revenue deficit is simple and straightforward. It denotes the difference between revenue receipts and the revenue expenditure. Thus, revenue deficit is equal to revenue expenditure minus revenue deficit. So, revenue deficit refers to the excess of revenue expenditure of the government over its revenue receipts. Next, what is fiscal deficit? Fiscal deficit is the excess of total expenditure of the government over its revenue, and capital receipts is excluding borrowings. Thus, fiscal deficit is equal to total budgetary expenditure minus revenue receipts minus capital receipts. So fiscal deficit, therefore, it is the measure of the excess expenditure over what may be termed as the government's own income. Thus, in the revised budget estimate of India in 2019 and 20, fiscal deficit amounted to 7,66,846 crore. Next, we are having what is a primary deficit. In recent years, the finance ministry has introduced one more concept of deficit known as the primary deficit. It was introduced for the first time in the budget of 1993 and 94. Primary deficit refers to the difference between fiscal deficit and interest payments of the government on its borrowing. So we can say that the primary deficit is equal to fiscal deficit minus interest payments. That is called the primary deficit. Thank you.